Welcome to Coleman Report Live. I'm Bob Coleman, and I have a voice today, and we're talking Main Street and the small business lenders who help it grow. Lance, thank you and John, thank you for filling in for me. I swallowed a frog, and I couldn't get rid of it for a couple weeks there. So thank you very much.
Well, Bob, I'm glad to hear your voice back to normal.
So am I. It was terrible. Hey, John, good to see you. Hey, let's start with a couple poll questions. We haven't done this in a while. Up at Lance's alley, how often do you have to take a junior mortgage on the residential real estate for an SBA 7A loan?
You know, this is one of those questions, Bob. I wish they would make a change in the new SOP 5010-7 and reword the all available collateral to, we don't have to look at junior mortgages on residential property because I'm not surprised that quite a few people do it more than 50% of the time. Sometimes they do it to meet SBA's requirements. Sometimes they do it for commitment from the borrower. But Bob, from a servicing perspective, you're always having to fill those, hey, I'm refinancing my first mortgage. Can you, release and refile, or can you subordinate?
And I want to do the pool, and I want to get a second.
Yeah. Or I want to sell my house. What can I do?
But I know, Lance, your philosophy is from a liquidation calculation, it doesn't add up, but you like to take it to help the commitment factor and having the borrower work out the situation.
It creates a commitment from the borrower. From a liquidation perspective, Bob, I can't ever tell you when we actually foreclosed on a junior mortgage in liquidation, but it does develop commitment on the part of the borrower to help the participant lender through the liquidation process.
Lance, you love to tell the story, but those junior liens, they tend to come up 10, 20 years later. I know you like to tell the story. You had a lien. Tell that story. It's a great story.
Junior lien on a piece of residential real estate. We went through liquidation. There was zero net collateral value at the time. The loan is presented for guaranteed purchase, charge off, it goes away, and 10 years later, the individual sells the house. Well, guess what pops up? We didn't release the junior mortgage, and it pops up, and there's a recovery for SBA and the participant lender from that junior mortgage. So it absolutely can come back. Probably in a real quick story, Bob. When I had a Radio Shack, I used to sell things on credit, and I sold a car stereo to a girl who put it in her boyfriend's car. They got married. They didn't pay me. I got a small claims court judgment. 3 years later, guess what they wanted to do? Buy a house. Guess what happened? They had to pay me off in order to get a house mortgage. So the junior residential real estate mortgage is kind of like that. It's a commitment, and sometimes it can lead to recovery down the road.
Lance, I know you're doing the webinar on Wednesday on this. Are you going to be talking about offering compromise? Because that's a good point to talk about that. On Wednesday? Lance? Well, one of us is gone, Joseph. Who is it?
Yeah,
Lance?
I hear you. John, can you hear us?
John's muted, so
I can hear you.
I'm here. Oh, there you go. Arkansas off the grid. Well, let's move on.
Let's go on the second poll. Yeah.
John, Wall Street Journal reported 52.7% of small business owners expect an economic condition in the United States to worsen.
There we are. I'm sorry, Bob. Everything froze on me, so I'm.
I know. Well, glad to have you back. John, what do you think about this? Is this just clickbait from the Wall Street Journal, or what's going on? And from your perch, how do you feel about this type of report?
Well, to an extent it is. There's any number of surveys right now that pretty much are delivering the same message. Businesses are being hammered by inflation, by supply chain shortages, by labor market shortages in some cases, and it doesn't affect all parts of the country the same. That's one interesting part of it. But I guess the overall message is that, the economy is teetering on the brink of recession. The president just sort of alluded to this fact the other day when he made a comment to the effect that a recession is not inevitable. I thought that was an interesting comment because he's at least acknowledging that the times are getting tough and that this
Right.
is not an economy that's humming right along anymore. So it's not surprising. It's just very interesting, perhaps, in just the number of the percentage of people who are I guess you could describe as pessimistic now as at 57%. But
John, you talked to a number of community bankers. Are they telling you the same thing, or do they have a little different view of this?
I think right now, we last talked to a lot of them about a month and a half ago during earnings season, and there was probably a little bit more optimism at that point then that, while a recession might be in the works, it wasn't coming until 2023, that 2022 would be a solid year, and I think that is beginning to turn the other way, that 2022 isn't going to be looked at as solid as it was, say, 6 weeks ago, and that 2023 is still, the dark clouds are gathering.
Yeah. I mean, we hear about retail getting hammered on their P&L. What about banks? How are they doing?
Banks are not getting hammered because what's happening with inflation, obviously there was just an increase in interest rates. There's going to be more, very likely going to be more. And so many of the loans that they make outside of mortgages, outside of SBA, are variable rate loans. So they float with the prevailing rate, and as the rate goes up, they go higher. So banks are going to be making more money. I mean, the one I guess downside is they've been enjoying an enormous amount of liquidity, and that's probably going away.
Right.
A point on that note, just recently there's a bank. It's an online bank. It's connected with Texas Capital Bank. It's called Bass Bank, but it's a unit of Texas Capital. They raised their interest rates to 1.25%. 5, 6, 10 years ago, that wouldn't probably impress anybody. But right now, after the run of really low interest that we've seen, especially if you're a saver, that all of a sudden is something to take a look at.
Right.
1.5%. So, and it's obviously that's going to, things are going to trend in that direction. So 6 months from now, if we're talking Bass Bank is probably, potentially going to have an even higher rate.
That's interesting you bring that up. I mean, investing in a bank's, putting your money in a bank savings account for the last 20 years, that wasn't even on the table, but it certainly is an investing option now, especially with all the gyrations that we get out of Wall Street these days.
That's right. Everybody is looking at losses in their stock portfolios, but the savers all of a sudden are seeing real gains. Unfortunately, those gains are being eaten away by inflation. So, nobody is really profiting. But
Well, John, one of the things I'm curious about is if the small business owners' less than positive review of the economy also has something to do with the fact that Walmart and Amazon both announced less than stellar sales growth, less than stellar earnings, and both commented about rising overhead.
Right, which are probably tied. Think about Walmart and the miles that they pile up on the roads with their trucks, tied to fuel prices. So Target as well, add to that list.
Yeah.
Right. All right. Lance, so what do you see? I know that you are always concerned about the liquidation servicing aspect. What's your advice for lenders?
Well, I I preach this message all the time, Bob, and sometimes it falls on less than receptive ears, but it is a time to sharpen up and gain as much knowledge and develop skills in servicing and liquidation, because I've been saying this for quite some time. I'm not projecting doomsday massive liquidations, but we've lived in a pretty liquidation-free environment for about 2 years. And now we're going to start to see some small businesses struggle that need some servicing help. We're also going to see some small businesses that default, and we're going to have to liquidation. So it's a great time to be working on getting those skill sets in place.
Yeah, John, it's always interesting. I'm not saying you said this, so please don't say that. But some analysts will say, well, banks are protected with the rising interest rate if the borrower's has a variable rate. Well, that's not true, because the borrower is the one taking the risk, and if they have additional cash flow, they're going to default, and therefore the bank's going to end up taking the loss. So a variable rate is not a free pass for the lenders, and that's why people like Lance are very, very important in staying on top of that.
I'd like to venture to make a prediction here,
Please.
With regard to credit quality, and I'm probably trying to stop myself so I don't look stupid 3 months from now. What have you.
Joseph, make sure the tape's rolling.
I've got a bunch of
It
might take 6 months for the true stupidity of the statement to prove itself out. But I'm going to posit or assert that banks overall, not just at SBA, but overall, will look better in terms of their credit quality, if you want to call it this upcoming correction that we're about to have, or very likely to have. I want to keep in mind what the president said, that it's not inevitable. But so I want to give him a little bit of credit.
Sure.
But let's assume that it is that it's going to come. I think banks will do better because, as someone pointed out just recently, the memory of 2008 is still fresh in the industry's mind, and they have been underwriting those loans since then with that sort of mindset. So there's a lot more. There's a lot less. I can't think of the proper industry term, but there's a lot. We're not seeing 99% loan to value, anything like that, or more like in the past. The loan to values are very much more conservative, and I think this will help overall keep hopefully moderating.
John, I'll also weigh in on that. I agree with you, but I also think our entrepreneurs are smarter.
Right.
Think about it. If someone's been around for 10 years, they navigated through the Great Recession. They had to navigate through a pandemic. They navigated through technological changes and all of that. And if they've been around for 10 or 15 years, you're dealing with some pretty smart Main Street operators who are, they're saying, give me your best hit. I've managed it all, and I'm still standing.
One other. Oh, I'm sorry, Les, go ahead.
One thing that John said that is really relevant, of course, I was a commercial lender during the last Great Recession when we had the significant real estate market correction. John, you were talking about the lending has changed. Absolutely. I remember home equity line of credit products in 2007 and 2008 where you could get 110% LTV because they were banking on real estate values continuing to rise. Yeah. I don't see those kind of products anymore on the market. So I agree with you, John. I think underwriting standards have improved so much as a result of what happened then that it won't be the same.
Yeah. Hey, let's shift gears on this. This is a great question from Max. I appreciate the question. We could spend literally an hour on this one, but here's the situation. We have a law firm, looks like a sole proprietorship, community property estate is owned 50-50 by husband and wife. Husband wants to pay the wife $5 million from an SBA loan. for her ownership, and then also the wife will continue to receive a buyout as a 1099 employee for 6 additional years. Lance, your thoughts about this?
So there's a problem with this one, Bob. Typically, when someone receives loan proceeds from a business ownership change, they may be able to continue as an advisor for a short period of time, but absolutely not 6 years. This has some eligibility issues. Max, the one thing I'm going to tell you is I'm not going to say absolutely not, you can't do it, but I'm going to tell you that this has to be a GP process. You have to submit a GP, because the heartburn I have, and there are divorces where one spouse buys out the other with SBA loans. But the big problem I have with this is the ongoing 125,000K, 125K 1099 employee with medical benefits. That normally in a business ownership change, the owner that gets money from the SBA loan goes away. And so there potentially are some eligibility issues with this, Max, and the only way I would consider it is if it were sent to SBA GP processing and let SBA make the eligibility determination, because I have a lot of heartburn. I don't think it's eligible from my perspective, but it doesn't mean that I wouldn't put it together and send it to SBA for review and potential approval or denial. But
my concern about the structure, Lance, is in the SOP. It states very clearly the loan has to benefit the small business concern.
yes.
And here you have a large amount of money going into a small business concern that's no benefit at all to the law firm. You're going to have to make that argument. And Lance, I would imagine if this was an early defaulted loan, you're going to have a lot more than heartburn.
Yeah, again, my biggest challenge with this loan is the ongoing relationship. I've seen business ownership changes, Bob and John and Max, where the person selling out, or in this case being bought out, maintained for like 90 days to a maximum of 6 months and was in an advisory role. It was for the betterment of the small business. But 6 years is way too long. And I have a feeling that this one potentially could have some eligibility issues. So absolutely submit this GP. Do not do it PLP.
Joseph, let's run the last poll question. And Lance, when you went frozen, I was asking you, this is another collateral question. We're going to go. There we go. In the collateral shortfall, SBA says you must take the personal residence as collateral. True, false, I don't know. But Lance, how important does offer and compromise come into the situation, and how often should we push for that to resolve these outstanding debts?
Well, sometimes an offer and compromise can come into play during the liquidation process if there is a junior mortgage on the residential real estate and the owner wants to obviously keep the house and avoid a potential foreclosure. And maybe they come up with another asset and say, hey, SBA, I've got $60,000 worth of equity in the property. I'll offer you 40 to release it, or 30, or whatever the appropriate offer is. But it's the SOP says if there's a collateral shortfall, you must take all available collateral. It doesn't specifically state the personal residence, but on most financial statements, that is an item that has to be looked at.
But what is the carve out for equity in that personal residence?
Generally, if it has less than 25% equity, you don't have to.
But however, Lance says,
take it for the commitment.
Okay, so this is one where the SOP allows you not to take it if there's less than 25% equity, but Lance says take it for the commitment. We got some good stuff from Delaney, but we're going to hold off on that, Delaney. It's good to see you back in the saddle also. I got a note here. Be sure and give Joseph a shout out for covering as well. Thank you, Joseph. You did that. Oh, and John, for you, what was the internet bank that John stated?
The internet bank is Bask Bank, B-A-S-K.
Okay. Thank you very much. And Lance, in the webinar on Wednesday, we're going to do collateral. And
We're going
that's
to talk about, yeah, we'll cover what we were talking about in the poll questions, Bob, and what you need to know to be compliant from a collateral perspective in 2022.
very good. Gentlemen, thank you very much. Thank you all for joining us today for Coleman Report Live and for supporting America's Main Street, one entrepreneur at a time.
Have a great day.
I love it.